That leaves 92 surviving funds. How did they do relative to the market? 42 of the remaining 92 funds pretty much matched the market. Their returns were within 1% of the overall market's return. That left 18 funds that beat the market by more than 1% and 32 funds that lagged the market by more than 1%. That makes sense too. If the price is usually fair, not too high, not too low, then it should be really hard to find winners in the stock market. You might think that you could do just as well by throwing darts at a list of stocks as you could by studying the stock market. In fact, most economists who study stocks think that's not so far from the truth. The idea that it's almost impossible to pick winners consistently has a formal name. It's called the efficient market hypothesis, and it was a big part of the reason that Eugene Fama won the Nobel Prize in 2013. We'll talk more about the efficient market hypothesis later in the course, but for now, all we need to know is that lots of research shows that stock returns are very close to random. They move up or down unpredictably, meaning that picking winners is really hard. Many people don't want to hear that. They want to make a quick profit, and every day they hear about this or that stock that went up. They figure that there just has to be a way to tell which ones will go up tomorrow. I can understand why they feel that way. Humans are hardwired to look for patterns. Uncertainty and randomness make us uncomfortable. We give names to things we don't understand, as if that'll give us some understanding or even control over uncertain events. If the stock market goes up or down for reasons we don't understand, then some people like to say, oh, that's just market psychology. Even though they don't understand it any more than they did before they named it, they feel better. I'm not a big fan of that approach. Saying that the market went up or down because of psychology doesn't help us make decisions about how we should invest. It just gives us a familiar term that we can attach to it. Let's not fall into that trap. Let's be honest with ourselves and just admit that we don't understand the forces that move the market that day. Psychology can still help us, though. Psychology can show us how to avoid some mistakes. Psychologists know that we humans love patterns. Show a human a sequence of events, and he'll try to find a pattern in it. In his book, Fooled by Randomness, The Hidden Role of Chance in Life and in the Markets, Nassim Taleb argues that the way we look at stock markets is no different. We instinctively want to find a pattern in stock prices. Just finding a pattern would make us more comfortable. Making money off that pattern would be a bonus. That does sound appealing, doesn't it? Sometimes stocks move up and sometimes stocks move down, and if we could only find the pattern in those movements, then we'd be rich. People who study charts of stock prices to unearth patterns are called technical analysts. For example, a few years ago, a stock was trading at about $10. The price wiggled around $10 for a couple of weeks, sometimes a bit below and sometimes a bit above. Then the price began a gradual increase to $12, stayed around $12 for another couple of weeks, and then ran up to over $16 in just a little over a week. Some technical analysts argued that the strong move up to $16 happened too quickly, so the decline back to about $10 over the next 2 or 3 weeks was predictable. With hindsight, it's easy to think that we could have seen this coming. In another case, a different stock was also trading at about $10. The stock fell on hard times almost immediately. The stock price dropped steadily to a low of just $1 in the span of about a month. But some smart technical analysts thought that 90% of a drop was just too steep too soon. They thought it made sense to bet on a rebound, and sure enough, over the next 3 months, it did rebound, pausing only around $6 for a couple of weeks before recovering almost all of the lost value. With hindsight, it's easy to think that we could have seen this coming too. Now let's look at IBM on June 1st, 2004. IBM was trading at about $88 per share, drifted erratically upward to almost $91 over the next 2 weeks, and then began a pretty sharp decline,